Hello, good morning, and welcome to this week's podcast brought to you by the Good Money Guide and our sponsors Pepperstone, who are a multi-regulated CFD broker providing trading services in forex stocks and commodities in multiple destinations. I'm Michael Hewson, and joining me once again is Pepperstone Senior Market Strategist Michael Brown. Good morning, Michael.
Very good morning to you, mates. It's been another tumultuous week in the markets.
Yeah, indeed. I mean, I was actually struck by the fact that, a week ago we were talking about the risk of obviously an escalation in Iran-US tensions, and certainly I think got off to a bit of a choppy start with oil prices surging on the back of the US bombing Iran's nuclear sites back to the Stone Age. But ultimately, um, the volatility we saw in the early part of the week has been sort of slightly overshadowed by the fact that essentially stocks are back on the front foot, yields are lower, the US dollar is lower, and oil has settled down. So, no one's really worried about Iran anymore.
No, absolutely right. I think it's very much a case of markets having firmly drawn a line under the tensions in the Middle East. You look at crude; we've priced out all of that geopolitical risk premium, and I guess the weekend U.S. airstrikes are another example of Trump's sort of escalate to de-escalate strategy, and it seems to have worked. And thus far, thankfully, without wishing to tempt fate, the ceasefire between Israel and Iran seems to be holding, and markets are taking the view that all is right in the world, and we see record highs on Wall Street.
Well, I mean, it's a risky strategy, but ultimately, I think you can only trade what you see.
Absolutely.
Anyway, before we get cracking, obviously that's going to be on our main topic for this week. Obviously, along with the weaker dollar, the lower yields, US markets are now back close to record highs. The Nasdaq 100 is at a record high. The S&P 500 futures, as we're speaking, look as if they're going to open at record highs, and we can sort of talk about the reasons for that. Potential for a tariff deadline extension beyond the 9th of July. Trump yields and the US dollar story, shadow Fed story. Talk about that. The fact that Trump may decide early on his new Fed chair. That's an interesting dynamic. Another reincarnation of the Shell BP takeover story. We'll talk about that. And another boost for the defence sector after NATO and agreed an increase to defence spending to 5% of GDP over the next 5 to 10 years.
Yes.
So there's I think there's a fair bit to get through, and that's before we even talk about next week's payrolls numbers.
Indeed. But before that, you need to make sure we're compliant.
Absolutely, and far be it from me not to do that. So, risk warning, here we go. The information provided here, whether from a third party or not, isn't to be considered as a recommendation or an offer to buy or sell, or the solicitation of an offer to buy or sell any security, financial product, or instrument, or to participate in any particular trading strategy. We advise any readers, viewers, or listeners of this content to seek their own advice. Spread bets and CFDs are complex instruments and come with a high degree of risk of losing money rapidly due to leverage. 74.8% of retail investor accounts lose money when trading spread bets and CFDs with this provider. Okay. Weaker dollar, lower yields, US markets back at record highs, European markets have lagged. Explain.
Yeah, well, I mean, I think firstly, the move in equities clearly comes from the geopolitical side of things. Markets are sort of resting easy with the idea that tensions in the Middle East are not necessarily over, but certainly we're way past the peak in terms of turmoil in the Middle East, and I think that has just given everyone clearance to pile back into risk trades. Europe lagging is not overly surprising. I mean, we've spoken about Europe outperformance for much of the year, so maybe the US is finally catching up a little bit. And then, as you alluded to in your introduction there, we've had another round of stories around the waters being muddied when it comes to Fed independence. Not only this idea that Trump may be naming his pick to replace Powell as soon as September, but also calls from Trump himself, Commerce Secretary Lutnick, to lower rates once again, and even some of the Trump appointees on the Fed board rather suspiciously turning from Uber hawks last year to Uber doves this year. And I think that's just serving to somewhat erode institutional confidence in the US, which is why we've seen these accelerated outflows out of the dollar, which, correct me if I'm wrong, is at roughly 3-year lows if you look at something like the dollar index.
Yeah, indeed. I mean, what do you make of that? I mean, because the dynamic in terms of the shadow Fed story is that he could make an appointment early. Um, and while that even of itself isn't a big problem, I think one of the early favourites was Kevin Walsh, I believe. But let's
Oh,
say
actually, sorry to interrupt.
yeah,
Find Kevin Walsh's name being in the mix for this, I find incredibly perplexing because if you think back to when Walsh was actually on the Fed board in 2008 to 2012, he was one of the most hawkish people on the board. I think even around the time of the Lehman bankruptcy, he was saying maybe we shouldn't do QE because I'm worried about inflation. And now everyone thinks he's going to be some sort of savior who'll deliver the lower rates that Trump wants. I'm not so sure on that one.
yeah, and obviously Michelle Bowman has also uh, sort of gone pivot as well as obviously
Mm.
Chris Waller. So I think what would happen, say for example, if in their manoeuvrings, Waller and Bowman, Trump decided to appoint Waller as the next Fed chair, and he's currently a governor on the FOMC. Would that
Mm.
create a bit of a tense dynamic between him and Powell?
I think it probably would. I mean, I'd certainly love to be a fly on the wall in the last 5 or 6 FOMC meetings that Powell would hold when his successor is essentially sat next to him around the boardroom table. I don't think it's going to change much from a policy perspective, though. I think it's important to look at, as you've rightly mentioned in the past, the committee as a whole. They make their decisions by majority vote. And certainly at the moment, you've got Bowman and Waller saying they may cut in July. Nobody else is on board with that. I think what's potentially more interesting is as you move into the start of next year, you're going to have a situation where at the moment you've got a 7-member board and only 2 of them have been chosen by Trump, Waller and Bowman. This time next year, you're going to have 4 of those 7 will have been chosen by Trump because obviously Powell will have left and his spot will likely have been filled. And also Governor Kugler, her term expires at the beginning of January next year. So I think it's at that point where you could have some really significant splits start to open up, where you've got a Fed board that is actually quite dovish, likely as a result of what Trump is wanting them to do. But actually, the regional presidents are much more, or relatively, much more hawkish and taking an approach where they should take a slower approach to delivering rate cuts. So I think it's going to be interesting how all that shakes out. But the sort of nub of it all is that, one, monetary policy uncertainty is likely to increase, and 2, monetary policy independence is likely to decrease. And both of those are going to pose pretty stiff headwinds to the dollar.
Yeah, I mean, is it though? I mean, people have made a lot of the fact that Waller and Bowman are Trump appointees. Okay,
Mm.
let's not forget Powell was a Trump appointee,
Well, you're
and
absolutely right.
now him and Trump are at loggerheads. So there's no guarantee that just because a Trump appointee is nominated as Fed chair, that appointee will suddenly start to play ball.
No, not at all. I think what I find troubling about what's going on at the moment is the context of it, whereby Bowman has recently, within the last couple of months, been promoted by Trump to vice chair for supervision. And seemingly miraculously, in her first public remarks since that promotion, has gone from someone who was worried about inflation last year, in fact, dissented against that 50 basis point cut last September, and is now sort of camped out far and away one of the most dovish members on the committee. You also have Waller, whose name has been thrown around as a contender for Fed chair, doing the same thing. So I think for me, it's not necessarily a case of Trump appointed them, which means they're going to do what he says. It's more a case of it's either an incredible coincidence or very suspicious that when jobs are on the line, they're suddenly doing what the president, or signaling that they're going to do what the president wants them to do.
Or telling the president what he wants to hear.
Yes, potentially. I mean,
I
the
mean,
July vote will be the interesting one, of course.
yeah.
Do they actually dissent for that cut, or is it all talk?
Yeah, I mean, let's not make no bones about this. We don't think there'll be a cut in July because there is no caucus on the FOMC for a cut. And when you've got people like Chicago Fed President Austin Goolsbee saying that he wants to, this week, saying that he needs to see more evidence of a slowdown in inflation, and he's probably one of the most dovish members on there consistently.
Well, he was.
Yeah, but I think he still is. I think
Yeah.
what we're seeing here is what you rightly say is political maneuvering on the part, or opportunism on the part of Waller and Bowman, telling the president what he wants to hear, so they get the nod. That doesn't necessarily mean that they're going to suddenly. They haven't suddenly had some Damascene conversion to the dovish side. Welcome to the dove side.
Yeah. No, but you're absolutely right. And I think, that's the important takeaway is certainly we don't expect there to be a July rate cut, even if inflation remains relatively benign in July or June and July. And of course, we're going to discuss the non-farm payrolls numbers momentarily.
Mm.
Even if the data does begin to soften, I still think the Fed would rather wait until September just to get a little bit more data, have some confirmation of what they're seeing. And also, of course, one thing that you've got to remember is there are effectively two opportunities between now and September for the Fed to make that pivot, whether it comes at the July FOMC itself or whether it comes at Jackson Hole at the end of August. And in fact, that could be a more plausible time where Powell goes, okay, we're confident that there are no second round inflationary effects of tariffs. We are now going to get back to lowering interest rates. But that's all way in the future.
Well, that's a signal, isn't it? The
Yeah.
Jackson Hole. Generally that's what previous Fed chairs have done to sort of tee up expectations for the September meeting, and essentially this September meeting is a rubber stamping of what they've said at essentially
Absolutely.
Jackson Hole. Certainly interesting in the context of the effect these recent events have had on US yields. They're at the lowest levels since early May. So certainly I think some of the tension has gone out of the bond market to a certain extent. Doesn't mean that it can't come back with a vengeance, but certainly I think we're starting to head into the summer period on a fairly optimistic note, and with momentum on our side when it comes to stock markets in general. The Nikkei is above 40,000 again. Looking at my chart, and the DAX looks as if it could well retest 24,000, and the FTSE 100 could well retest the highs of earlier this month.
Yeah. No, you're absolutely right. It does seem like momentum is firmly with the bulls at the moment, and you wouldn't really want to bet against, or certainly I wouldn't want to bet against that path of least resistance continuing to just lead slowly but surely higher. I mean, obviously there are risks out there. If we do start to see the US economy crack in a more significant way, or if we do see tariffs come back onto the agenda, I think that 9th of July deadline, which may now not be a deadline, is creeping up on us very, very quickly indeed. So there are risks out there, but I think fundamentally the bull case remains a very, very strong one.
Well, you've actually said that deadline could be extended beyond the 9th of July, and certainly for autos there is some indication, given recent comments from Caroline Levitt, the Trump's press spokesman, that could well be the case. The door has been left open to that, and obviously we've got the US-China trade framework, which has been recycled, I think, more times than my bin collections.
Yeah, I mean, I think this morning, Friday morning, if you're listening to this later on, is the third or fourth time that they've trotted out this, we've got a trade deal, we've just signed this. Yeah, you've signed a bit of paper to, as you said, rubber stamp a previous bit of paper, which rubber stamped a previous agreement. You're not actually doing anything new. It does seem, though, as if the groundwork is, and this is, of course, pending Trump saying something on Truth, the groundwork does seem to be getting laid for this 9th of July deadline to slide, whether it be an outright can kick of we extend it for another 90 days, or whether it be a case of we've got one-page memoranda of understanding with countries, which means they stay at a 10% baseline levy while we do more negotiations. I don't think, and this could be famous last words, but I don't think we're going back to Liberation Day, 50% on Europe, 45% on Vietnam, etc., because the US has shown that they've got firstly, no desire, and secondly, no ability to stomach the impact of tariffs at that huge level.
Well, I think it's self-preservation. I think once it becomes evident that there are cracks appearing in the US economy, I think Trump will realize that he's pushed this particular narrative as far as he can, and hopefully he will have got some form of concessions from an awful lot of his trading peers in the process. Certainly one concession that he's got was NATO this week.
Indeed.
Agreeing to an increase to defence spending of 5% of GDP over the next 10 years, which on the face of it, apart from the Spanish, which on the face of it looks positive for the defence sector, until you actually dig a little bit deeper. And
I was going to say, there's some creative accounting going on with that one, I think, isn't there, to be kind?
Yeah. I mean, the UK government is looking to include expansion of Heathrow Airport and rolling out of urban broadband. That's not defence spending. Now, no matter how much you try and slice and dice it,
No,
um,
it's not.
but nonetheless, the defence sector has had a really good week.
Well, I think if I'm right if I've read this correctly, I think it's the way they're phrasing it is 5% in total, 3.5% on defence, and the extra 1.5%. I think they're terming it security, which, as you said, in the UK government are using farcical things like rural broadband as an excuse to meet this target. And I think pensions will probably be included in defence pensions, which is obviously nonsense. But the sort of fundamental issue here is the majority of, if you take that out, the majority of NATO countries are struggling to get near 2% on defence. Proportion is still going to go to at least 3.5%. So again, it's unsurprising that defence stocks continue to trade well because we are going to see spending in that sector going in only one direction for the foreseeable future. I guess it comes back to what we were discussing previously with companies like Babcock, where you're going, actually, is the question now not one of, is there going to be spending? We know there's going to be spending. It's, can the firms in the sector actually keep up with demand?
Yeah, exactly. And that involves spending money on extra capex. But in looking at this week's numbers from Babcock, people don't appear to be too concerned about that. Before I get into that, that gives me the opportunity to tee up the content for next week's podcast, because we're going to have a half-time report, if you like.
Indeed.
Because obviously we're coming up to the end of the quarter, end of the month, but also the end of the half year. And it'll be interesting, I think, to look at what's done well, what hasn't, and what that tells us, I think, in the context of what we can expect over the course of the rest of the year. But I think it's been quite clear that banks have done well this quarter, not this quarter, this half year. So have defence firms. The DAX has probably been the best performer of all the indices. The FTSE 100 hasn't done too badly either. So it's a good opportunity, I think, to look back at some of our more questionable calls, but also look back at some of our
been a few of them.
yeah, a few of them, but some of obviously also more of our positive ones. And it's something that I used to do at CMC on a fairly regular basis. What's done well, what hasn't done well, and hopefully what will continue to deliver over the course of the rest of the year as we head into the summer, what I would call the summer doldrums, because essentially I think what happens now, once we get into July, an awful lot of people go away on holiday, and not an awful lot happens, barring the occasional exception between now and September, and the focus again once becomes Jackson Hole and the next potential policy pivot on the part of the Fed.
Yeah, no, I think you're absolutely right. I'm looking forward to doing that review next week. I used the phrase summer markets in a note this week. Is that a little bit too early? But no, it's probably not. I mean, it is Independence Day next Friday, of course, and then we're into all the school kids being off on holiday and all the rest of it. So we do probably have sort of 2, maybe 3 weeks left of decent market conditions, and then everyone will be back in September, essentially.
Yeah, and on that note, I mean, we've got payrolls on Thursday.
Yes.
But that essentially means that I think the US is likely to have a half day on Thursday. So we're probably only going to get a 3.5-day trading week next week.
Yeah. Well, both cash equities and treasuries are closing early on Thursday anyway.
Yeah.
So,
So
no one's sitting at their desk when there's nothing open. Or if you are, then ask yourself some questions of what you're doing.
yeah. So obviously we've got payrolls next week. As I say, I don't think it's going to shift the dial in terms of a July Fed rate cut. We're not going to get one unless we get an absolutely diabolical payrolls report. And I think you really got to decide, what can be termed as diabolical. I think one of the things I took away from the May payrolls report was the fact that manufacturing payrolls slid 8,000, government slid 1,000, while labour participation also slowed to 62.4% from 62.6%. So there is a slowdown happening. People don't leave the workforce if they're confident about getting a new position. So I would argue there are cracks there. They're starting to form, but I don't think they're overly worrisome at the moment.
No, I agree with that framing, actually. I think the labour market is slowing, but I don't think it's on the verge of disaster at this moment in time. I mean, you're absolutely right. I think the best framing, I think, is probably one of inertia, really, where we have a slowdown being seen in hiring, but we also have a relatively low pace of firing and of job losses as well. So companies are holding on to employees, which is a sign that, they're not overly worried about the future. It's more a case of we just want to take a slightly more conservative approach with pulling back on hiring, as opposed to actually enacting layoffs. And that's why we see something like the continuing claims metric, which is at a cycle high 1.79 million or whatever it is. That implies that people are losing their jobs and taking longer to find another job. I guess there's two ways that you can look at the labour market over the next 6 months or so. The way I would look at it is a case of, as and when the degree of economic uncertainty, particularly around trade, lifts considerably, I would expect businesses to go back to those hiring plans and actually put them into place. I think it's more a case of those plans have been paused as opposed to scrapped entirely. And when uncertainty lifts, you should see those plans enacted once more. The slightly more bearish interpretation is actually those plans have been scrapped entirely, and those cracks are going to become larger and larger and larger, and it's only some rate cuts that will solve the issue. I don't subscribe to that view just yet, but it's certainly something that, I think people need to potentially have an open mind towards if we do get a run of 2 or 3 soft labour market numbers.
Yeah, we jumped ahead a little bit there.
We
but
did,
yeah,
yes.
we did. But I mean, I think it was a good segue to sort of discuss that in the context of what to expect next week.
I think sorry, just to finish up on payrolls, I think the one thing I would say is, while it's not going to move the needle for the Fed at the end of this month, July is going to be unchanged in terms of the Fed funds rate. I think the market reaction could be a bit more significant, because one of the things we touched on it earlier on. We've all kind of gone for a while now. The U.S. economy is pretty solid. Underlying growth is okay. The labour market's doing all right. If you're suddenly having to reassess one of those assumptions, then that could cause markets to have perhaps a little bit of a wobble.
Yeah, but then again, you could then get markets starting to price in earlier rate cuts. So that could have the reverse effect in actually pushing stock markets higher. So, it pays your money, it takes your choice, I suppose. I think it's going to take something quite substantial to undermine the current momentum that we've got in place when it comes to, stock markets moving higher. We'll have the occasional, wobble. Like we did over the weekend in the futures markets, but once normal trading resumes, generally I think there is this desire amongst politicians, despite all the noise, to keep financial markets on a fairly even keel, I think.
Yeah, no, I fully agree with that.
Okay, so we talked earlier about the defence sector, and we'll get onto that, because this week Babcock's reported their full-year numbers for 2025, and that wasn't really, I think, the real story. I think it was their guidance and some of the comments that were made by the company's CEO, David Lockwood. But before we get onto that, I think I'd like your take on the reincarnation of the Shell BP takeover story. I mean, you sent me a link over WhatsApp. Have you seen this? And I think, oh God, we're not doing this again, are we? Because does this mean BP is in play? Yeah, it probably does. But I would argue that no more than it has been previously. There's going to be speculation about Abu Dhabi National looking to acquire the company's gas assets, and there's going to be speculation that Shell might be tempted to take over. But as with all of this speculation, why? It's going to cost them an arm and a leg. And there are synergies, but there are so many other obstacles in place as well. It would take years.
Yeah, I think you're absolutely right. So, I mean, it was very much a case of, are we really doing this again? I guess the only sort of difference, I would say, is it's a case of, previously it was very much speculation. Now it's a case of they have actually been talking to each other. Although Shell came out and went, there are no talks taking place, doesn't mean they didn't take place in the past. I think the other sort of little nugget that was buried in all this reporting that seems to have been overlooked is this idea that actually a potential breakup of BP is potentially growing a little bit more likely. It's if the firm is to be sold and they can't turn things around on their own, it's unlikely to be sold in its entirety. That, of course, raises all sorts of not only competition concerns but national security concerns as well, frankly. So yeah, it's one that continues to bubble away. You grabbed a few headlines, which I guess is good for the journos writing the stories. Does it change things materially? Not really.
So generate a few clicks.
Yeah, exactly that.
Clickbait.
It had a bit of upside in BP's share price, at least temporarily. But yeah, it's one of those where at some point there will be a concrete plan that Elliott are happy with in terms of BP's turnaround, and I think we're just still waiting for that.
In terms of national security, Michael, do you think this government understands that?
Well, I was hoping you wouldn't go there because now I'm on very shaky ground with as to what
Well,
I can say.
That's precisely why I went there.
I would like to hope that and have some faith that some clever person in the civil service would at least steer the government in the right direction if they fail to recognise those concerns of their own accord. But if we were to sell off our gas infrastructure or a proportion of our natural gas infrastructure to a state-owned firm out of Abu Dhabi without any sort of national security probe into it or someone blocking that, then it could be a new low for us, I think.
Yeah, it is like herding toddlers, isn't it?
It does feel that way. And I don't envy the civil service on that one.
Okay, so that neatly brings us on to Babcock's and the defence sector actually in general, which has had a fairly decent quarter and without a quarter or half, and without wanting to preempt what we're going to discuss next week, Babcock's share price is up over 120% year to date. And you look at, say, someone like Kinetic, they're still up around about 20 odd percent. So certainly been a very, very solid quarter. But what was particularly interesting, and this was something that I took from the CEO of Babcock, his comments that European governments were less focused on cost savings and more focused on deliverability. Now, that is a significant shift, I think, from the thinking when it comes to defence over the last 20 years. Governments have been penny pinching the defence budgets. Can you do this cheaper? Can you do this cheaper? Blah, blah, blah. And essentially, it's a competition for the lowest bidder who then puts in such a stupid bid and then ends up then ramping up the costs going forward. And it's like all of these government procurement contracts, the contract goes to the lowest bidder who knows full well they can't deliver it at the price. And I use HS2 as a case in point, which then ends up costing a hell of a lot more. It's now about how quickly can you deliver it? And that, for me, I think means that the likelihood is their margins are likely to go an awful lot higher because essentially the Babcocks and the defence companies can essentially say how much you're prepared to pay.
Yeah, no, exactly that. You're almost to the point where you're dealing with price insensitive buyers, where actually having the product and having the capability is of more importance than the price that is paid. And they are also, of course, price insensitive buyers who have this week turned around to everyone and gone, we now have a massive cash pile that we need to spend on your products. So it would be very surprising indeed if margins didn't increase. I think the other thing with that statement is it shows it's a recognition that actually they are finally taking this seriously. It's not a case of, oh, yes, we know we need to spend more on defense. We do need to do more on security. It's actually, no, we acknowledge that and we are doing that and we don't particularly care what we're paying. We just need to get these capabilities in place. So perhaps at long last, Europe are finally getting real on that.
Yeah, I mean, I'm looking at Babcock's numbers here. Full-year revenues, £4.83 billion, which is an increase of 11%. With the possibility of more to come. Underlying operating profit rose 53% to £363 million, with the nuclear division doing an awful lot of the heavy lifting. Margins are also higher. They rose to 7.5% from 5.4%, with the likelihood is that they've said that they can go to 8 by the end of the current fiscal year of 2026. So what point does this all get priced in?
Yeah, that's the question, especially when they're up 120%. Year to date, you're almost asking, are we there already? There may be some more upside, but we have come a very long way in 6 months. That is something that I think you need to be cognizant of, and for the bar for further gains is probably quite a high one, given how much good news is priced in.
I would also argue that perhaps it's not, because we're not at record highs for Babcock. Record highs back in 2014. The share price has gone from when it went from well above £12 to as low as £2. We're now back at just below £12. So I think there is potential for Babcock share price to actually take out those record highs, given the fact that the company is now in a much better place
Than it was a decade ago.
or even 3 years ago.
Well, yeah, certainly.
So the momentum is clearly on its side. The big question is, are we going to get a dip for new buyers to get in? I mean, I think the fact that they announced a buyback as well.
I was going to say they probably wouldn't mind a dip, actually, to be completely honest on that front.
The company announced a 200 billion. Is this a 200 billion share buyback, or is it? I don't know. I'll have to check those numbers.
200 million, I think it was.
I think it's 200 million. Yeah.
Yeah.
I think that seems rather high.
Because that's buying back 50 times your revenue would be
that's
a little
my
bit
bad,
punchy, wouldn't it?
Yeah, 200 million share buyback. So I'll have to change that on my notes. What was interesting though, 4.83 billion in revenue, and they've got an order book of 10.4 billion.
Yeah.
A backlog. So I think they've got enough work to be getting on with, let alone any new work that's likely to come their way.
Very much so.
What we've also seen this week, Halfords came out with their full year numbers. That was a bit of a mixed bag, that one. It was a bit of a strange one, because yesterday their share price fell really sharply the day after they released their numbers, which strikes me as a little bit strange. And the numbers by and large were fairly decent. Retail was fairly positive. Cash flows improved, increasing 13.6 million on 2024. Lower inventory. Not much to dislike, yet for some reason yesterday's share price got absolutely clobbered down to the lowest levels since beginning of May. So I'm sort of struggling to understand the rationale behind that particular move.
You and me both, to be completely honest with you, because the day the earnings came out, the market almost didn't notice it. And then the day after, you've got this... Yeah, and then you've got this huge delayed reaction the following day. The earnings were sort of very ordinary, I suppose. Not much to like, not much to dislike. Their outlook perhaps wasn't as, and guidance perhaps wasn't as positive as it could be, with the year starting in line with expectations as opposed to beating them, and the CEO talking about his cautious optimism. Frankly, it is a little bit of a head scratcher, that one.
And we had FedEx. They reported, and again, bit of a drop in the share price. Nothing, I think, to really be overly concerned about. I think there was some disappointment over the guidance, first quarter guidance. The actual numbers themselves were fairly decent. They came in above expectations on revenues, and I think a large part of that was down to the fact that you got an awful lot of what I would call forward buying, or whatever it's called, with respect to getting ahead of Tariff Liberation Day tariffs, which helped it. But a decline in profits. So, this is a bit of a difficult one. If a logistics company is a bellwether of the economy that it supports, what if FedEx results tell us about the US economy?
Well, they don't paint the prettiest picture, that's for sure. And I think that's something that has probably been overlooked. The impact has been very isolated to FedEx stock and some of its peers, as opposed to more broadly. I think the issue with FedEx was more around the uncertainty in demand, as opposed to predicting an outright decline in demand, which perhaps is a little bit of a silver lining within all that. But it is a worry, because we spoke last week. They are a bellwether stock. How much is moved around the world these days, not only in terms of e-commerce, but just more generally. And if they are seeing signs that things are slowing down, then I think we should take that as a little bit of a sort of amber warning light on the dashboard. Not sounding the alarm just yet, but it's something that I think is important to be aware of when they are painting what is ultimately quite a downbeat picture.
The Q1 guidance said that it would include a $170 million hit in relation to global trade policy impacts, which is tariffs to you and me. Forecast revenues flat to up 2% year on year, so that's not too bad, but profit was lower. And again, I think that ties in with the tariff impact story. So
yeah, absolutely.
And not really much to write home about on FedEx numbers, but also nothing that was really surprising either. Nike, on the other hand, they're up 11% in the pre-market after last night's numbers. And
They are.
we talked about this last week. How bad could Q4 be? With, I think, the bar so low, perhaps the fact that the revenue decline for Q4 was low teens as opposed to mid-teens has actually been taken as a positive. Any thoughts on that, Michael?
Well, I think you're right in saying that the bar was so low that it was relatively easy for them to beat it. I mean, the earnings slate itself wasn't the best. In fact, it was actually pretty grim. Certainly when you compare it year on year. Sales were down 12, 13%. Net income was down. Pretty much everything was down compared to where it was. And they're also saying that tariffs are going to cost them $1 billion, as they are at the moment, before any other changes that may take place and supply chain issues and all the rest of it. So there's not a lot in there. If you purely looked at those earnings on their own, you'd go, well, this is pretty ugly. The stock should be down 11%. But I think it is a classic case of the context around it was they've been beaten up so much and everyone expected it to be terrible that it just wasn't quite as bad as expected, and it's a little bit of a relief rally.
Yeah, I mean, the shares did fall to 8-year lows back in April. So, maybe there's that. Also, it does appear that their store sales, as opposed to the direct sales, are actually doing better. And I think the new CEO is shifting the narrative slightly away from Nike Direct to more wholesale. And there does appear to be a pickup there. But certainly, I think the fact that you've got 16% of your supply chain in China, that's an issue.
That's a huge issue.
And that's something that they are looking to address, hence the fact that obviously they're talking $1 billion, in costs. So, go on.
I was to say that what I do think is going to be interesting now with Nike is they'd said previously and they guided towards this being the worst it's going to get, the low point of the whole turnaround that they're on. So that's the real question now, is when we sat here in 3 months, did their financial Q4 prove to be that low point, or have things actually got even worse? I think that's really the focus for them now going forward.
Well, they said they expect to see a 7% decline in Q1 sales. So that would be the lowest decline over the last 4 quarters. So, maybe we are getting what I would call a bit of a dead cat bounce here in terms of, well, it's not got any worse. Now the declines are actually the lowest they've been for over a year. Maybe there's signs of a turnaround taking place here. And I think we're seeing that reflected in, obviously, the pre-market. It'll be interesting to see whether it's sustained when the market actually opens in a few hours' time. But certainly, I think there are silver linings in the Nike share price, I think, in terms of the early market reaction. And maybe the swoosh that we're currently seeing is sustained.
I've been biting my tongue for this whole little segment, trying not to make a pun, but you just did it.
I did it. I went there. Anyway,
shall we move swiftly on?
Let's move on to next week, because I think we've pretty much covered most of next week when we talked about payrolls, because I think it's fairly light on macro. Yeah, we have flash.
It's only a 3.5 day week anyway, so
we've got flash CPI out of the EU. I mean, but we're already back at target. So I think the big question for me is whether or not we get any indication that the ECB might be tempted to go further. I think they're probably done for the time being. Maybe we'll see something maybe towards the end of the year.
Yeah, I think that's about right. I think the ECB were pretty clear in earlier this month that they are done unless something forces their hand. All this narrative around policy being in a good place and being well positioned, et cetera, et cetera, et cetera. You don't say that if you think you're going to have to do more on a policy front. I would say we have had marginally hotter than expected inflation numbers out of France and out of Spain this morning. But fundamentally, I think the ECB are going to try and sit on the sidelines for as long as they can, at least until September, when obviously they give us another round of projections. Yeah, barring a significant external shock, they're probably done and dusted, and terminal is 2%.
Yeah, well, I mean, we've had 8 rate cuts in the last 12 months. I mean, how many more can they really do? I mean, they can do an awful lot more, but
what's the point?
What's the point? Yeah, exactly. Okay, so that's pretty much it for this week. One thing I would say about next week's is fairly light on the earnings front, but we do have the first quarterly numbers from Sainsbury's. And given the fact that one of the key takeaways from Tesco's was its resilience, I think, in terms of the UK consumer. But I think what struck me was whether or not that will, I think, translate into Sainsbury's. I mean, their share price has had a pretty good run since early April, gone from 220p to around about 288p now. Number two supermarket in the UK. Did Tesco increase its market share at the expense of Sainsbury's or its peers? Having visited Sainsbury's, they're
Been
still the
out to do
best.
some market research, have you?
Yeah, well, they're still, they're still fairly decent set of stores. And obviously they've got the Argos business as well. So recent earnings announcements have shown that DIY has done okay. That sector, Kingfisher,
Yeah.
B&Q. Argos obviously does slightly more than that. They do electrical as well. And obviously we've got Currys full year numbers next week as well. I would argue that perhaps they could be more resilient than perhaps people think.
Yeah, I think I'd be along with you on that one. I mean, generally speaking, it seems like the consumer is doing okay, or has had a relatively okay first half of the year. I mean, I know retail sales were soft in May, the data that we had out last week, but that was really just giving back what had been pulled forward into March and April anyway. So yeah, I think you're probably right. I think we could see a little bit more resilience in both of those. I think the focus will really be on guidance. Clearly there are a lot of downside risks still in the economy, particularly when it comes to the labour market, which is softening very rapidly. Also how the two are adapting or trying to adapt to the much higher national insurance bills that they're now facing. I think that's going to be the interesting aspect. But as for the performance itself, yeah, I wouldn't be surprised if they did both show a pretty strong degree of resilience.
Well, the recent Kantar numbers are usually a generally decent bellwether, and they showed that grocery sales rose 5% for the 12 weeks to June for Sainsbury's, although volumes were lower. And Sainsbury, like Tesco, also managed to increase its market share to 15.2%. So I think if they're able to deliver on what the Kantar numbers told us, then certainly I think any potential downside in the share price is likely to be fairly limited to the lows that we saw, I think, probably at the beginning of June. I think the key thing here will be its guidance for 2026. And as a reminder, that was underlying profits of £1 billion along with free cash flow of £500 million. So it'll be interesting to see whether or not it's able to sustain the share price gains that we've seen since the beginning of April.
Yeah, absolutely.
Currys full year numbers, again, performed well so far year to date, helped in no small part by a big guidance upgrade back in April, which helped to propel the shares to where they currently are, 20% above, up over 20% year to date. So the bar here is quite high for Currys. Given what Appliances Online showed us, they were fairly decent numbers. I don't expect too many surprises, but again, with Currys, the bar is a lot higher than it was for AO World because the bar was lower there. So
yeah, I think that's the way to look at it. We're looking for a resilient set of numbers. The problem is Currys has priced in a hell of a lot more good news than AO had prior to their release. So the market reaction, the market is looking to see a much more significant beat, probably with some decent guidance as well, rather than just numbers that are in line with expectations in order to unlock a positive reaction to that.
And in terms of the Trump trade story, I think a good bellwether stock for that is Constellation Brands, who make Corona and Modelo beer. Now, their share price is currently sitting pretty much close to the lowest levels this year. And the US announced a 25% tariff on all imported canned beer as well as empty aluminium cans. Now, Berkshire Hathaway took a stake in Constellation Brands. Maybe that wasn't such a good idea, but again, maybe all the bad news is priced in, because even though most of its supply chain is in Mexico, maybe we could get an upside surprise on that particular story. Certainly, I think the markets will drink to that if it is.
Oh, dearie me. I was going to say something serious. I might not bother now. What I was going to say before that terrible pun, was that it feels like about a decade ago now, but the whole US tariffs on Mexico and Canada are ostensibly around the issue of fentanyl. The belief is that they are essentially a precursor to a renegotiation of the USMCA trade deal. So actually, Buffett buying in around the lows is potentially not the worst idea in the world if, as you say, a lot of the bad news has been priced in and that 25% tariff is likely to be a short-term headwind as opposed to something that is in place for a prolonged period of time.
Yeah, I mean, they were quite bearish on their guidance for 2026. So I think they know better than anybody the effect that a continued tariff of
We'll have,
25%
yeah.
will have on its business model. So I think the bigger question here is, um, you know, are they more pessimistic now than they
Yeah.
were 3 months ago? And as we all
It
know,
would be worrying if they were,
yeah, it
given
would
that
be.
we are sort of way past the peak in terms of uncertain. It is still an uncertain environment. The tariff's still in place, but we're way past the peak of that. So if they're sat there going, we're more bearish now than we were 3 months ago, that's a big red flag, I think.
Yeah, I mean, to be fair, Berkshire Hathaway only spent $1.2 billion.
Which
We're
is
not
the
talking.
equivalent to you or I spending a fiver.
Yeah, exactly. I mean, when they got a cash pile of $330 billion,
Yeah.
it's pocket change really, but it's still 5.62 million shares. And generally he's not a bad judge. So it could well be that in 5 years' time he makes a tidy profit on it.
Exactly that.
Okie dokie. All right. Well, I think that's pretty much it. I think we've covered pretty much everything that I wanted to cover this
I think
week.
we have, mate. Yeah.
So on that note, I think we can probably wrap this up. And as I say, have a quick preview of, not a quick preview, but a fairly lengthy, in-depth preview of what's gone right over the course of the last 6 months, what hasn't gone right, and what could happen over the next 6 months. So like a halftime report for
Looking forward
equity
to that.
markets in general. All right. Well, until then, thanks very much for listening, ladies and gents. Until next week, have a great weekend.
Bye bye.